The DoubleLine Total Return Bond Fund, ticker symbol DBLTX, outperformed its benchmark, the Bloomberg U.S. Aggregate Bond Index, by 5 basis points during the quarter, bringing its year-to-date outperformance to 40 basis points. Contributing to relative performance was the fund's securitized credit exposure. This is a diversified mix of securitized credit, which includes non-agency residential and commercial mortgage-backed securities, asset-backed securities, and collateralized loan obligations. This part of the portfolio tends to exhibit lower interest rate sensitivity relative to the investment-grade corporate bonds within the AG index, and thus outperformed as treasury rates across tenors rose during the quarter. Detracting from relative performance was the fund's government securities, which includes agency mortgage-backed securities, agency commercial mortgage-backed securities, and U.S. treasuries. This part of the portfolio represented roughly 57% of the fund during the quarter and exhibited a longer interest rate duration relative to the treasuries in the agency MBS within the AG index, and thus experienced larger price declines as treasury rates rose. Using this barbell approach of longer duration government-backed assets and shorter duration securitized credit, the fund's overall duration was roughly parallel to that of its index during the 3-month period. Regarding allocation changes during the quarter, the fund continued to improve overall credit quality while maintaining its duration. The team capitalized on increased market volatility to increase exposure to agency mortgage-backed securities as current coupon spreads reached their widest levels in the post-global financial crisis era at the end of May, implying attractive valuations. Further, given that many agency MBS trade at discounted dollar prices and the risk of prepayment and extension remains low at this juncture, the convexity or return per unit of risk profile for mortgages broadly remains attractive. At quarter end, nearly 60% of the fund's assets remained in government-backed securities, and the other 40% in securitized credit, focusing largely on the senior portions of the capital structure. As of June 30th, the fund's duration was 6.31 years, in line with that of its benchmark, while its yield to maturity was 6.33%, roughly 150 basis points greater than that of its benchmark. Further, the dollar price of the portfolio was near the lowest it has been since the fund's inception and has the potential for further price appreciation. For additional market perspectives, please visit DoubleLine.com, email fundinfo@doubleline.com, or reach out to your DoubleLine sales representative.